Hello, I'm Maria Dawes. I'm one of the portfolio managers at Capstone Asset Management. Welcome to another edition of Your Wealth Matters. Today, I'm joined by my fellow portfolio manager, Janet Kimsing. Hi, Janet.
Thanks, Maria, and hello.
So tax season, we made it out alive. Yay.
Yes, from a personal taxes perspective, yes.
That's true. Anyway, back in late 2020, we had initiated a series on retirement planning videos, and we spoke about the Registered Retirement Income Fund, or RRIFs. And just following up on that, I thought it would be a good opportunity to back up a bit and discuss the Registered Retirement Savings Funds, or RSPs themselves. I think looking at it now when we're technically no longer in RSP season is really important because a lot of people will really benefit if they start planning their RSP contributions earlier in the year. Then it's much more of a proactive tax planning and retirement planning strategy through the year and less of a reactionary, I'm not sure what I need to put into my RSP to help me out, but I need to do it tomorrow event. We want to avoid that.
Right, yeah. So having a good understanding of RRSP accounts and how they can help us out today, and of course during retirement, is worth digging into a bit more now. So perhaps let's review the basics of an RRSP and go from there.
Sure, that's a good place to start. So, an RSP, or Registered Retirement Savings Plan, allows Canadians to contribute into a plan, into a savings account, and the growth is tax-free. The greatest benefit to saving through an RSP is not only the tax savings while it's invested, but the contributions, or the deposits, are deducted from your income up to your personal contribution limit, which you can usually find on your notice of assessment. So, as a very simple illustration, if you have income of, let's say, $100,000 and a contribution limit of $30,000, so you can contribute up to $30,000, and maybe this amount has been built up from previous unused amounts, you can reduce your taxable income by whatever you contribute to the RSP, up to $30,000. As you can see, you can greatly benefit from the reduced taxes in addition to the tax savings on the underlying growth in your investments, which happens over time. It seems simple enough, right? Well, it is. Having said that, there are examples when an RSP may not be beneficial, and one needs to discern whether they could potentially fall into this category. So, Janet, why don't you walk us through that scenario?
Sure. So as Maria mentioned, part of the benefit of contributing to an RRSP is that you get a deduction from your income from these contributions. However, the flip side is that any withdrawals eventually made either from an RRSP or from the RIF, if it has been converted, will be taxable income to you, or I guess I should technically say to the annuitant. But we'll talk through spousal RRSPs shortly. Of course, the idea is that by the time you are making regular withdrawals from a RIF, you are in a lower marginal tax bracket. So you do end up paying less tax than if you hadn't made these RRSP contributions at all. There are certain individuals who, typically through generous pensions in combination with government benefits, including CPP and OAS, or business owners who expect to receive business income through their retirement years, they could find themselves in a position where they will be receiving more income in their retirement years, and thus finding themselves in a higher marginal tax bracket. So for those such individuals, it would not make sense to use an RRSP. So that's something to think about because the RRSP may not be useful for everyone. And if you're unsure which category you fall into, that's something we're happy to discuss. So now let's move on to spousal RRSPs. Maria, with the introduction of pension income splitting back in 2007, has the use of spousal RRSPs become obsolete?
Yes and no. But first, let's redefine what a spousal RSP is. A spousal RSP is an RSP where the contributor, who tends to be the higher earning spouse, can contribute to the lower earning spouse's RSP. The contributor will receive the tax deduction, but the annuitant, who is the lower earning spouse, will be taxed when the funds are eventually withdrawn. Which means they're typically in a lower tax bracket, and there's then some savings there. Back in 2007, our government introduced pension income splitting, allowing higher income spouses to split certain types of qualifying income with their lower income spouses, providing that the higher income earner is 65 years or older. This is just basic couples pension splitting, typically, or income splitting. RIF income is eligible for pension splitting. So for those that are 65 or older, they can withdraw from their RIF. and split up to 50% with their spouses. However, often there is still the situation where their higher earning spouse is maybe still drawing an income after age 65 through their employment. And so in these cases, having an RSP or RIF in the lower income tax spouse's name provides maximum flexibility for income tax planning. So you have one spouse potentially earning employment income and the other one pension income. The one spouse can withdraw 100% of the RIF pension income, and the other one, of course, the employment income. Of course, there's also the flexibility if the lower income spouse wants to withdraw part of the RSP in a year of little to no income if they need it then. And this is even before the age of 65, and that can be really useful for a family. The only caveat to this is that if the lower income spouse withdraws from their spousal RSP or RIF within 2 calendar years of the last contribution, then the income won't be attributed to them. It'll be attributed to the higher earning spouse. They're the ones who originally received the tax break. So you do need to be aware of the timing here. Okay, enough about spousal RSP accounts. Why don't we wrap up this discussion by quickly mentioning the importance of beneficiaries on RSP accounts?
Yes, beneficiaries, which is a very important point. So when possible, we highly recommend designating a beneficiary directly on your RRSP, as this will bypass your will along with the associated probate fees. Usually the spouse is designated as a beneficiary, and upon passing of the annuitant, the RRSP is rolled over in what is called a spousal rollover with no tax consequences. If you do not have a spouse to designate, but you have named perhaps your children equally as beneficiaries, that's what we see very often, it's worth noting that the RRSP or RIF would be considered income in the year of death. So you'll want to ensure that there is a mechanism in place to pay the tax bill on this. We spoke about this a little bit in our last investor update on RIFs, and so that would be a good reference point if you'd like some more info.
Phew, so that's a lot of information, but for those who are interested in further discussing whether an RSP or a spousal RSP are worthwhile for your specific situation, please be in touch with us. We'd be happy to help, and the sooner the better.
Bye for now, and until next time.
Bye.